easyJet rejected Castlelake's fourth takeaway bid on Thursday, yet simultaneously handed the U.S. firm access to its commercial books and 9 more days to improve the offer. That combination stopped the market cold. The Budget Airlines Board called the 650p per share proposal, valuing easyJet at £4.93 billion, substantially undervaluing the company, invoking the same language used against 3 prior bids. Yet the concession on data access was something new. A board that genuinely believes a bid is unserious does not open its books to the bidder. The provisional answer to what changed sits in the fourth proposal itself. Castlelake added Brookfield Asset Management to the consortium, a $700 billion infrastructure investor whose involvement signals credible financing capacity and signals a bid structure that could actually close. That shift in consortium credibility, not the marginal 25p price increase from 625p to 650p, is what moved the board from flat rejection to conditional engagement. The market took note. easyJet shares jumped as much as 8% on Thursday, to around 580p, the highest level since well before the Iran war depressed stock below 400p. But 580p is still below the 650p bid, and well below the 700p floor that JP Morgan analysts flagged as the minimum the board would seriously consider. That gap is the unresolved question this video answers.
easyJet's valuation argument rests on 2 figures that Castlelake's 650p offer does not reach. The first is the asset base. At the last count, easyJet's board put the value of its owned assets at approximately £5 billion, the bulk of which is the 208 aircraft it owns outright, plus high-value landing slots at capacity-constrained European airports, Milan, Geneva, and Luton near London among them. Castlelake's £4.93 billion offer would effectively hand the buyer those hard assets at a modest premium, while stripping out the earnings potential entirely. The second figure is the medium-term profit target, greater than £1 billion in pre-tax profit, still officially intact despite the current year being hit by Middle East fuel costs. The board's argument is that today's depressed earnings are temporary, fuel costs elevated by the Iran conflict, bookings softer than last year, while the structural improvement program, including 90 Airbus Neo family aircraft deliveries through 2028, replacing 79 older A319s, is permanent. Newer planes burn materially less fuel and carry more passengers. At a low-cost carrier, the economics of every seat sold improve as the fleet rotates. But here is where the market's read diverges from the board's. Oldfield Partners Samuel Ziff, an easyJet shareholder, said any bid needs to be significantly higher and pointed to fleet value and 2030 profitability targets. Goodbody stockbrokers Dudley Shanley said the opposite on the same day. The board's data concession means the business is for sale at the right price. Both are responding to the same disclosure. The conflict is not analytical. It is a read on what the board's concession actually signals. One side believes the board opened the books as a negotiating tactic to extract a higher price from a credible buyer. The other believes the board opened the books because it concluded that the downside risk, Castlelake walking away on July 5th and the shares reverting to pre-bid levels near 400p, outweighs the premium lost by not waiting for 700p. That divergence between 2 named investors acting on the same fact is the unresolved tension driving the shares today.
Even if Castlelake raises its bid above 700p, a separate obstacle sits underneath the price debate that no increment of cash resolves on its own. European aviation law requires that airlines holding EU operating licenses be majority-owned and majority-controlled by EU nationals. easyJet holds such a license, and critically, it still operates under EU ownership rules even post-Brexit, because its Airbus fleet operates extensively across EU airspace. Castlelake, headquartered in Minneapolis, cannot directly hold majority control. Its solution is a 2-tier structure, a bidding vehicle where the remaining 51% is owned by Peter Ballou and Mark Breen, 2 EU nationals brought in as the formal controlling shareholders. Ballou is a former chief operating officer of easyJet itself. Breen leads Wyneros Aerospace. easyJet's board called this structure opaque and raised significant questions of deliverability. The IAG chief executive, running British Airways' parent company, went further, saying EU competition rules make any imminent bid practically non-viable. The consensus assumption in Castlelake's structure is that a 51% formal equity stake held by 2 individuals with no operating airline backing satisfies EU regulators. That assumption is untested at this scale. The Telegraph noted that if EU ownership rules can be this easily bypassed, regulators would be watching closely. Brookfield's addition to the consortium raises the economic firepower but does not resolve the legal control question. Brookfield is also a non-EU entity. This means the deal has two barriers, not one: price and structure. JP Morgan pointed to questions over ownership structure as a distinct risk layer, separate from whether Castlelake can afford the airline. The buried assumption the board's critics are making is that a higher offer renders the structural question moot. History in European aviation suggests the opposite. Ownership rule disputes have delayed or blocked deals regardless of agreed price.
easyJet's shares at 573p sit in a narrow corridor defined by two outcomes. If Castlelake tables a firm bid above 700p before the 5 July deadline, the shares re-rate sharply upward. The gap to 700p is roughly 22% from Thursday's close. If Castlelake walks away, the shares lose the entire takeover premium and revert toward the pre-bid range below 400p, a potential 30% drawdown from current levels. The counter-evidence against the Finstratstrackreed is real. Founder Stelios Hadjiianou, who controls roughly 15% of the company with his family, has said nothing publicly in support of either side. Without the Hadjiianou family's backing, Castlelake cannot force the board's hand through shareholder pressure alone. That silence is not neutral. It is the key variable the market has not priced clearly. A holder today faces the question of whether to accept a near-term asymmetric exit, sell near the bid premium before 5 July, or hold through the deadline for the possibility of a higher firm offer. A watcher faces the mirror question, whether to enter at 573p against a potential 700p bid or wait for the deadline to clarify. The single indicator that resolves this cleanest is not a price level but an action: any public statement from Stelios Hadjiianou before 5 July. His signal carries more weight than any further board commentary, because his 15% stake makes him the swing vote in any formal offer process. If the founder remains silent through the deadline, Castlelake's path to a successful bid narrows sharply even at a higher price. The move becomes an entry setup if Castlelake returns above 700p with confirmed EU structural approval and Hadjiianou's non-objection. It becomes a trap if the deadline passes without a firm bid and the founder stays silent. In that scenario, the shares revert toward the 4p range and the takeover premium fully unwinds. Watch for any Hadjiianou statement before 5 July. That is the trigger that tells you which scenario is live. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.